Good afternoon, everyone. We are very pleased to have you this afternoon on this webinar, which we are very excited to share our insights on a very current topic, which is called COVID-19 transfer pricing implications for Malaysia. And particularly given the situation of the second wave, that will be a very, very relevant topic for all of our attendees today. I know you're all eager to get started, but before we dive into the topic, let us introduce our firm. So our firm specializes in providing transfer pricing advisory service to multinational groups around the world. We are a firm that attracts the best talent in the regions that we are active, and passionate individuals who love transfer pricing and who love to serve our clients. And we have, for those who don't know our firm, even though I can see some familiar names in the attendees list, we have 3 offices: our head office located in Australia, our subsidiary located in Singapore that caters to the Asia Pacific clients, and our subsidiary in Malaysia that caters to the Malaysian clients. We are also very active in the industry, and we are regular contributors of the high industry journals. And we have also been awarded several awards, such as Asia Newcomer Firm of the Year, Asia Transfer Pricing Leader of the Year, and Australia Firm of the Year. With that, I am pleased to introduce our panelists for today. We have as a first presenter, Mr. Hon Chuan Tan, and let me just go back here, who is the director and co-founder of Transfer Pricing Solutions Malaysia. I will say that he is a brilliant technical mind who prides himself to go the extra mile for his clients. He has set up a transfer pricing practice for one of the leading accounting firms in Malaysia prior to joining Transfer Pricing Solutions. He has over 10 years of experience advising multinational companies in the area of transfer pricing. I would also like to introduce you to our second panelist for today, who is Kevin Tai. Kevin Tai is our senior manager for Asia with over 9 years of experience in transfer pricing, advising multinational companies in Australia, Asia, and the US. He's passionate about technical issues and solving complex transfer pricing issues for his clients. And I will be the moderator for today. Let me just do a brief introduction about myself. I'm the director and lead technical partner for Singapore and Malaysia. I am the co-founder of Transfer Pricing Solutions Asia and Malaysia with more than 15 years of experience advising multinational companies in the area of international tax and transfer pricing. And with that, let me introduce our agenda for today. As you both, you all know, the goal of our webinar today is to give all of our attendees tools and tips on how to manage the transfer pricing risk that can arise in the area of tax and transfer pricing as a result of the COVID-19 environment. So before we get started, we will be touching in 2 key main aspects today. Number 1 will be the OECD guidance that was released in December 2020, covering core aspects of how to manage transfer pricing risk for multinational companies. And we will also cover the application of the OECD transfer pricing guidance on managing COVID-19 for Malaysian taxpayers. Before we deep down into our first topic, let me release or launch our first poll question for today. And we will be more than happy to have all the attendees participating so we can know and understand more what are the challenges that you're facing. So we will give about 2 minutes for people to respond. Give me 2 seconds. I think we're having a bit of an issue, or is it?
Yep. Like we can
did
see
it launch both? Can you please?
Both, apparently.
Hello?
Yeah, it's both. Okay, seems to be a technical issue here. Let's see. All right. Yeah, Joanna's left. All right. Okay, she's back.
Hi, Jenna, you're muted.
Hi, everyone. Sorry for internet giving us a bit of a hard time today. I think everyone in Singapore is logging in due to the new working from home, but let me just reshare the slides. And maybe in the interest of time, I don't know if the attendees managed to participate in the poll, or should I just relaunch it?
You might have to relaunch it because
okay.
I stopped halfway.
Okay, so let me just relaunch the polling. There you go. Okay, question number 1 is, what has been the impact of COVID-19 on your company? We had to change our transfer pricing policy for some transactions. We had to change the contract for some transactions, not effect at all. And the second question is, what has been the financial impact of COVID-19 in your company, with the options being our company has been profitable, our company has been in losses, and not effect at all. So we are up to 40% participants. If everyone makes, now we are 36. We're up to.
It would be interesting to see the impact of COVID-19 on your company, so that general review on the respective industries in Malaysia, see what's the overall impact.
Yeah, yeah, that would be definitely interesting to see. Okay, we have 50% votes. I will leave it for 30 seconds more, and then we can close. All right. I will end the poll now. Excellent. So can you see the results?
Oh, wow.
Yeah. So we have very mixed answers. For question number 1, we have 50% not having effect, which I think is a great news. Companies that do not have any effect, some that may have been forced to change the contract, about 29%, and about 21% who have been having to change the transfer pricing policy. For our second question, we have that 33% have not had any financial impact, which is great news. 50% have been experiencing losses, which is probably very important topic that we will cover today. And 17% has been profitable. So with that, I will, and with those of you who have been having to deal with the losses or changes in the pricing, I think some of the topics and the tips that we'll share today will be very useful. So let's start with the OECD guidance and what does the OECD has or has provided a view for taxpayers around the world to implement. So we have to keep in mind that the OECD guidance is a globally accepted guidance for all transfer pricing practitioners and tax authorities around the world. For those of you who have been practicing transfer pricing for a long time will know that we kind of consider the OECD like the transfer pricing Bible. And that's why it is extremely important to understand what the OECD has to say, because a lot of the times is kind of our Bible to find guidance whenever there is not guidance in the local law. So we will be covering specifically 4 key aspects in our webinar related to OECD guidance. One will be the effect on comparability analysis. 2, losses and allocation of COVID-19 specific costs. 3, government assistance programs. And 4, advanced pricing arrangement or agreements. And with that, I want to pass the baton to Hong Chuan, asking him first of all to share some views on the OECD guidance and what are the insights on comparability analysis, and also sharing for those who are not specialists in TP a little bit about what is comparability analysis.
All right, thanks, Adriana, and thank you for joining us for this webinar. We hope that it will be insightful to you. So let's start off with comparability analysis. So in any transfer pricing analysis, comparability analysis is actually key to determine the most appropriate comparables given the circumstances. So particularly in a rapidly changing market environment, comparability analysis is actually essential to make sure that your transfer pricing analysis reflect the actual market conditions that you are analyzing, more so now in this pandemic environment. So what is comparability analysis, you say? It is a process of eliminating the differences between the information used in a transfer pricing analysis and the taxpayer circumstances that will materially impact the reliability of the analysis. So actually to do this, we'll need to make sure that the information that we used are contemporaneous, so which means like most recently available. For our case, it would be the impact of COVID-19 in this stage, right? This can be any form of publicly available information regarding the effect of COVID-19 on the business, industry, and controlled transaction. So examples of these sources of information can be analysis of how sales volume has changed during COVID-19, pre and post COVID-19. Information on incremental or exceptional costs borne by your company or your related parties or the group as a whole, and the extent to which government assistance has been received. So you have to quantify the effect, you have to identify the type of assistance they have obtained and the respective accounting treatments. Next would be the macroeconomic information such as country-specific GDP, or industry indicators from central banks, government agencies, or trade associations like your Federal Malaysian Manufacturer Association. Comparison of budgeted or forecasted data against that of actual results to determine the specific effects of COVID-19 or revenue costs and margins. And Lastly, will be the analysis of the effects on profitability or on third-party behavior observed in previous recessionary periods, or using any data available in the current year, right? The global financial crisis that had happened between 2007 and 2008 is a very good example for us to observe, right? We have to see what happened during GFC. What are the approaches that were used to determine, the effect of the GFC, right? So that's very important. Next, we're going to talk about the timing itself, right? Timing is very important. Obviously, the most reliable information is to use the contemporaneous uncontrolled transaction. However, when we are talking about external financials, the 2020 information will typically not be available until mid-2021, which is around now. But bear in mind that financials may be delayed due to the extensions provided by the government to actually, lodge the financial statements to the Malaysian Companies Commission. So it may be around the third quarter of 2021 where we'll be able to see financials coming out, right? To note that using data from prior years without considering the specific impact of the pandemic may not lead to a sufficiently reliable transfer pricing analysis or outcome. Hence, we'll need to be mindful of how we utilize the data at hand, the historical data, right? Next, we are going to talk about the use of TP methods and multiple year data. This is a very popular subject. The application of more than one TP method may be useful to corroborate and strengthen our justification, right? While the OECD actually generally recommend using the most appropriate method approach, a multi-method approach could be very useful to provide a more robust analysis during the pandemic. Some of the recommended approaches by the OECD are to have separate testing periods to take into account the impact of COVID-19, as long as the data from independent comparables can be measured over a similar period in a consistent manner. And with government assistance readily available, we'll also need to take into account these assistance and make the necessary adjustments on a case-by-case basis to ensure reliable comparability. Finally, let's talk about utilizing loss-making comparables, right? This is a very important area that we need to consider. In general, there's no overriding rule on the inclusion or exclusion of loss-making comparables in the OECD guidelines. However, practically speaking, tax authorities generally exclude average loss-making comparables on the basis that independent companies operate to actually make a profit and not losses, right? Well, that makes sense, but to a certain extent. That's where we come in and we have to provide our justification to the IRB why we actually accept those loss-making comparable companies, right? Generally speaking, loss-making comparables that satisfy the comparability criteria should not be rejected on the sole basis that they suffered losses in periods affected by the pandemic. So previously, we would have thought that 2020 would be the year, but then COVID-19 effect is lingering, which would have delayed until 2021 or further on until the whole situation is actually controlled. Lastly, when performing a comparability analysis, we should include loss-making comparables when the accurate delineation of the transaction indicates that the comparables are reliable, right? Which means that the comparables assume similar level of risks and have been similarly impacted by the pandemic as against that of your company, right? So this concludes the comparability analysis section. Thank you.
Thank you, Honchuntan. I think three key things that I take of what you have said so far. One is value, value, value. What is the effect? Two will be timing, being strategic about how to use the data, and as much as possible to use the closest data to the year in which COVID-19 started. And 3, which is a very welcome coming from the OECD, is the possibility to use loss-making comparables, because I think there has to be some level of flexibility. So with that, I would like to call Kevin Tai to come into our panel to give us a little bit of background of probably one of the most common questions that we have received from our clients. And it's like, if I have losses, how do I deal with them, and how I can make sure that I manage my risk associated with losses and specific COVID-19 costs. With that, Kevin, I will be more than happy for you to come forward and give us your views, as I know you're very passionate about this topic.
Yeah, this question again, right? Thanks, Adriana. Yes, this is indeed one of the question that always comes up during our recent discussion with our clients. Yeah, we all know the magnitudes of COVID-19 impact to our economy over the past 12 months. Many companies, especially even here with us, from the poll, we can see 50% of us were in losses now, due to maybe a combination of business disruptions and some additional operating costs that you incurred to maintain a safe working environment to keep the business going, right? So with all this going on, we always get asked, like, how do we manage these losses and costs from a transfer pricing perspective? Can we allocate perhaps some or all of these costs or losses to our related parties? Now, before we get excited and start doing the transfer pricing for that, the OECD has highlighted sort of 3 key issues that we need to consider. Now, we will go through it on a high level, but feel free to ask questions in the chat section if you have any. Basically, what it says that firstly, we go back to the basics, right? We look at the allocation of risk between related party across the supply chains. Who bears certain risk relating to this cost or market impact? For example, who bear the market risk, right? Second, we should consider how independent party behave in relation, or how they treat all these costs. For example, look at your industry. Is it common for players in your industry to allocate certain pandemic-related costs to entities within the supply chain, or are you expected to absorb this cost as part of business? Now, to this point, we actually have a quite interesting discussion with the Singapore Tax Authority recently. Just to give you a quick overview, one of the key points that was raised during the discussion is whether the entity bearing all these additional costs is involved in the decision-making process, or do they have power over how they will manage the pandemic risk impacting them. So as a general rule, if the entity have control or is responsible to manage this risk themselves, they are expected to bear the cost and impact of the pandemic. Lastly, when we think about allocating losses or costs to related parties, we should also consider what was written in your intercompany agreements, if you have one in place. Whether the agreements allows you to do this allocation that you are planning to do, and if there's any force majeure clauses in the agreement that allows you to revoke or revise the intercompany agreement. Okay. Now, all this is good, and it applies generally to all entities, but we have, in transfer pricing, we have an entity or arrangement called the limited risk arrangements. Okay. People ask, what about limited risk arrangement, limited risk entity? Now, historically, tax authority have this idea in their mind that tells them that limited risk entity should not be making losses. Now, this may be valid in an ideal world, but in practice, it's not always the case. Obviously, it really depends on the facts and circumstances and should be looked at on a case-by-case basis. But to give you a background of what I mean, the term limited risk is commonly used in transfer pricing. However, this term is not clearly defined in the OECD guidelines in terms of what function, risk, or asset profile this entity should have. So you might end up with a situation that you have a few different limited risk entities with different risk profile. Therefore, it is not possible to establish a general rule that limits that says limited risk entities should or should not be having losses. Okay, for instance, there are some limited risk entities that take on a portion or a fraction of market risk within the supply chain. In this case, yes, they may be in losses during market downturn. But it is generally accepted by the OECD that limited risk entities should not be making losses for a long period of time. They can be in losses for a short period, but not long period. So when we are looking at, when we are asking the question whether limited risk entity should be incurring losses, we should first consider the facts and circumstances of the entity and assess the risk assumed by the entity. But of course, if you want to support a loss-making position for a limited risk entity, it is very important to build up a robust financial analysis and have a good transfer pricing documentation in place, because this is a very sensitive topic. Okay, now what do we have next?
Then I would like you to cover some points, and I think I love the way in which you point out the coming back to TP basics and having a robust position. Now maybe if you could give us a little bit of your views on how to treat operational or exceptional costs, that would be great.
Yep, okay, good. So when we look at allocation of operating and exceptional costs with your related parties, it is important to consider how these costs would be allocated between independent parties as well. Now, we have listed some key questions in these slides for you that we think can help you work out if it is reasonable to allocate certain costs to your related parties. Now, firstly, the first question, now this applies to, or applies consistently in any transfer pricing study. This is the arm's length principle. Consider what would an independent parties do. How do two independent parties allocate these costs when they're dealing with each other? Okay, we should also look at what are the risk assumptions when we are talking about related party dealings and the supply chain. Who bears the risk? And if we are looking at from a third party perspective, how would they treat these costs? Are they going to include it as part of their selling price? Maybe if they are limited risk, or are they going to absorb it themselves if they are full risk business? Okay. Now, the next one is to look at who perform activities or who is responsible for activity related to this cost, and who assume the risk related to these activities. This links back to our previous slides where we talk about our discussion with the Singapore Tax Authority. A general rule: if you are involved in the decision making, you have the responsibility to bear this cost. Then maybe it's not fair to say that you will allocate 100% of this cost to your related parties. Maybe you will bear half of it. Okay. And lastly, always in transfer pricing, we need to make sure we have done a thorough analysis before we implement any transfer pricing policy. Go through all the key points that we have discussed earlier to make sure you're comfortable, everything is reasonable before you actually make the allocation. Now, the next two questions is more towards financial and comparability analysis for your transfer pricing study. Okay, but before we go into that, we need to understand, when we come to cost, we need to determine whether this cost is an operational cost or an exceptional cost. Why is this important? Because in a transfer pricing analysis, we will generally exclude exceptional costs. We call it, the one-off cost that doesn't occur every time, every year in your business. When we are calculating your profitability, or we call it the net profit indicator. Now, with this in mind, we need to ask ourselves, is any of the additional costs related to a long-term or permanent change to your business operation? If the answer is yes, then it will probably or most likely be treated as an operating cost. The next one will be whether or not this cost arise as a result to substitute the meaning of you conducting business activities. Again, if the answer is yes, then it will be treated as operating costs. But what do I mean by that? To give you an example, let's take Zoom subscription for an example, okay? Before the pandemic hits, maybe Zoom is not a common thing in your workplace. You might only subscribe for it for a particular project that you need to use, and that's it. It's a one-off thing. But during this pandemic and maybe potentially post-pandemic, this may be a norm in your workplace now, as people are getting more used to home work arrangement. Then from then on, it has a long-term permanent change to your business. It substitutes the way you run your business, and it will be operating expenses moving on. Okay. So what do we have next, Adriana?
Thank you, Kevin. So that is really helpful. And I think I really like the Zoom example because that really shows how a cost can substitute the way in which you run business. Now, if you could spend the next 5 minutes talking about two additional topics. One will be first, the government assistance programs, and what are the views from the OECD on how can you treat the government assistance programs from a transfer pricing point of view?
Yep, government assistance. Yes, this is another interesting topic. Now, because government assistance can be different from company to company and can be given in very different forms, like monetary or non-monetary forms, it could have quite significant transfer pricing implication. Think about how a standard arm's length analysis is carried out. We always compare the pricing or profitability achieved from your related party dealings with third-party dealings. When you have government assistance in place, it creates some inconsistency between your situation and the third arm's length situation. Now, what it means that you need to pay a bit more attention when you are doing your transfer pricing analysis. You have to make sure the assistance did not impact the pricing of the related party dealings, and any potential comparability issues is dealt with when you're doing your study. Okay. Again, to this end, OECD provided some guidance on how we can address this. It's a three-question approach again. Firstly, we look at whether or not the receipt of government assistance is an economic relevant characteristic. What this means is basically whether this government assistance have direct impact on the pricing of your related party dealings. Example will be where you are a fixed return distributor receiving a wage subsidy from a government. Because the wage directly impact your overall return for your company, it can also impact how you price your related party dealings in this context. Okay. When we're looking at this, we need to consider the terms and conditions of the assistance program provided to you. Now, generally, from our observation, government assistance usually have some sort of term and condition attached to it that prevent you to provide the benefits to your overseas related party through transfer pricing. Okay. Now, the second question is, what if the government assistance is economically relevant to you? Now, this does not mean that your transfer pricing is impacted by the government assistance by default. It just means that you need to pay a bit more attention when you're doing your transfer pricing analysis. The OECD suggests that where you receive such assistance and is economically relevant to you, you include that in the transfer pricing documentation, so you can support, the transfer pricing analysis you've done for the year. Now, the last one is almost like a summary of what we have discussed so far on what we should consider whether the government assistance affect the price of your related party dealings. Now, this can be done by, again, determining whether the assistance is economically relevant. You have a clear, accurate delineation of the control transactions, and you perform a thorough comparability analysis to eliminate any potential issues. Okay. Now, when we are talking about comparability analysis, HC's already talked about it, but on a high level in relation to government assistance, there are a few steps that we usually follow to make sure we address all these comparability issues. First, we consider whether the government assistance are similar between your tested party and your comparables. We try to pick comparables that are within the same or similar geographic location. We will consider whether or not it's appropriate to include a corroborative analysis to provide additional support to your main analysis. And obviously, accounting treatment of the government assistance need to be considered when you're doing your comparability analysis.
Thank you, Kevin,
Okay.
for that. So I think one of the key points here also is the fact that with the government assistance, and if there is not a possibility to do adjustments to both the tested party and the comparables, you may have to resort to finding comparables in your same country, so you can be sure that based on the industry and the country, the government assistance that can impact the profit base is the same. The next, I would like you to share in 2 minutes what are the views of the OECD on advanced pricing agreements and how they can be impacted by the COVID-19.
Cool. Yeah. All right. Another interesting topic, the APAs. When we talk about APAs, the question is always, should we, respect and follow through any our existing APA given the impact of the pandemic, right? The simple and short answer is yes, unless there is a breach of critical assumption, which is your term and condition of the APA. If you look at this diagram, if there's no breach on your terms and condition, or breach of critical assumption, then both you and taxpayer and the tax authority should respect, maintain, and uphold the terms of the APA. What happens if there is a breach, right? That's the main question. So if there's a breach, our suggestion is look at your the terms and conditions of your APA, whether or not it talks about the consequences or a remedial plan if there's a breach. Have a look at if you have any agreement or arrangement with the tax authority on how to deal with certain breaches, or maybe even look at domestic law or procedures that addresses this. Generally, we recommend to adopt a transparent and proactive approach in this kind of circumstances. The best way is to approach the tax office as soon as you notice there's a breach, and just talk to them and come up with a solution. From there on, you can consider whether to revise, cancel, or revoke the APA. The next question is, what about the new APA or the APA that are being under negotiation now? Okay, so to that, because of the uncertainty, many people doesn't want to do it. But the OECD did say that they suggest a flexible approach in negotiation with new APAs during this pandemic time. They have suggested a few solutions that we can have make reference to. We just quickly go through it. Basically, option 1 or solution 1 is to consider having two different APA. One short term to cover the pandemic's period, and then another one to cover post-pandemic period. So you will have two. Solution 2, maybe you conclude the APA negotiation as normal you would do during the normal time, with one additional condition where you have to analyze the impact of the pandemic and report it annually once they are known. So from then, you make retrospective amendments to the APA accordingly. Another options or another solution will be just to extend the cover period of your APA, make it longer. And that potentially will help mitigate the effect of pandemic, because the pandemic usually will not be a long-term thing. It would be a short-term thing.
Thank you, Kevin. So with that, I would like to move on to our second topic and last topic before we open for questions, which relates to the localization or what the OECD guidance means for Malaysian taxpayers. And it would be great that the Hon Chuan, if you can start giving us a little bit of localization and flavor of what this means for Malaysian taxpayers.
All right. Thanks, Adriana and Kevin. Let's talk about Malaysia. On a side note, not here to say you guys, but recently we have experienced an increase in TP audits in Malaysia. And I can see that RIB is really aggressive in getting their money back. So please be vigilant. So in terms of Malaysian guidance, the RIB has yet to issue any specific COVID-19 guidance on transfer pricing, but would most likely follow the OECD guidance. Additionally, the RIB has actually released a few frequently asked questions, FAQs, in relation to APA, as well as certain international taxation issues, right? Next, we'll go through the Malaysian approach, similar to what we have gone through earlier, but I will emphasize on some key sections related to Malaysia. On a comparability analysis note, the RIB very much prefers Malaysian comparables, as mentioned by you, Adriana, where some of the government assistance may be best to look at local comparables. Therefore, taxpayers would have to ensure that the local comparables satisfy the comparability analysis. So similar to what we have discussed earlier, the same approach applies, right? We can use multiple years data when historical latest available year data is not available. Then choices of comparables and the use of loss-making companies. This is where it's very important. Similarly, based on my experience, the IRBs does not prefer loss-making comparables, and proper analysis is definitely required for the acceptance of these comparables going forward. Next would be, account for the impact of COVID-19 on comparables, use of corroborative analysis. Then we have upward compensating adjustments. Upward compensating adjustment means adjustments made to increase the transfer prices, generally at the end of the financial year, right? Taxpayers need to treat this carefully, as the compensating adjustment can be a double-edged sword, right? Upward adjustments in one jurisdiction would mean downward adjustment in another jurisdiction, right? Which may lead to a domino effect that we have covered in our previous webinar. The double taxation issues, the relative issues that involves adjustments. So proper, as usual, proper justification is definitely required for both sides to make sure that you are able to justify why you've made that compensating adjustments to your transfer prices. Right. Lastly, we have the variance analysis, which is the budgeted versus actual financials. And last but not least, benchmarking should be updated once the 2020 financials are out. Right.
Thank you, Juan Chan. I would like to also ask you to give us some tips on losses and allocation, on how you will treat it from a Malaysian point of view.
Yes. Well, this is very similar to the session covered brilliantly by Kevin, but I would like to reiterate this on the general business model in Malaysia, right? As you know, a lot of foreign control entities in Malaysia are generally in the nature of routine/limited risk distributors. You may be a contract manufacturer or a shared service provider where a fixed margin is earned, right? So this needs to be communicated between your headquarters, as transfer pricing measures or pressures from headquarters may impact your entity's profitability post-COVID, right? Now, these measures needs to be analyzed and supported by operational and commercial reasons, right? We have already have cases and experience current situation where headquarters are putting pressures to your routine service providers where they want to downward adjust their pricing, which means that documentation will need to be revised as to why the downward adjustment on a group basis. So that's very important.
Yeah. And I think another point there is that that adjustment has to also be made symmetrically if there is a contract in place. So there will have to be some amendments on the contract. So could you also share your views on government grants in Malaysia?
Government grant in Malaysia. Yeah, in Malaysia, even before COVID, we can be considered the home of tax incentives. And that was an ongoing joke previously, as Malaysia as a tax haven, even though we are not like the BVI or the Cayman Islands, but we have a lot of tax incentives covering a lot of industries just to incentivize foreign entities to come in and invest in Malaysia, right? Which is a good thing to the Malaysian economy. Right. Similarly, we have quite a few COVID-19 related government assistance, which include but not limited to tax incentive on foreign companies that relocate their business operations into Malaysia and have made new investments in the manufacturing industry. Double deduction provided on pre-commencement expenses incurred by international shipping companies for setting up regional offices in Malaysia. Right, all these regional offices in Malaysia will be beneficial to by the economy. Further tax deduction given to the employers who adopt flexible work arrangements. We have also other government aids like wage subsidy programs, microcredit schemes for SMEs, if you guys know of, to assist your cash flow needs, and Dana Jamin Guarantee Scheme, or SHGPT, where private sectors to cover working capital with a guarantee, and also allow foreign-owned companies operating in Malaysia to also obtain this guarantee. Right, as mentioned, taxpayers should document details of these government aid provided to them.
Okay.
In detail. Yep.
I think looking at this looks a lot like our Singapore framework in the sense that we also have quite a lot of incentives. And I think one point that maybe will be very difficult to substantiate in Malaysia as it is in Singapore is that you pass any tax incentives or grants benefits to the related parties, especially when Malaysia is a subsidiary type of country. I think most subsidiaries will have to basically maintain their benefits locally, because I think that's the spirit of the law, and it will be very hard to do any adjustments to pass the benefit to the related parties. It would be now great if you could share your views on another point, which is the substance test, and what we mean by that.
Yeah, it's a very important area, which is the creation of PE, permanent establishment, during the pandemic, right? You have the substance test. Due to the globalization and the travel restriction in many countries, you will find many of the employees of the companies working remotely, where many of them provide virtual advice, like we do now, and information. Given that most of the work are done virtually and through email correspondences, would this be sufficient as a evidence of beneficial or value-added services, or does it contradict with the substance test that tax authorities expect to verify under the business as usual circumstances, right? Does this create PE in Malaysia? Right. Good thing is RIB actually issued an FAQ where they provide explanation on situation where what would or would not create a PE in Malaysia, right? According to the FAQ, the temporary presence of employees does not necessarily result in the creation of PE in Malaysia, provided that it meets certain criteria, right? The criteria such as whether the company does not have a PE in Malaysia before the existence of the COVID-19 travel restrictions. There are no other changes to the economic circumstances of the economy. the temporary presence of the employees in Malaysia is solely due to the travel restrictions related to COVID-19. And lastly, the activities performed by the employees during their temporary presence would not have been performed in Malaysia if not for the COVID-19 travel restrictions, right? So it actually boils down to the COVID-19 impact, right? Nevertheless, companies should articulate and document the temporary changes to ensure that the companies can continue to justify its transfer pricing positions in Malaysia.
Thank you, Chuan. And last for this afternoon, before we open for questions, I forgot to mention, or just a reminder, that we have a question chat box, and if or a Q&A question. If you have any question, please post them, and we will answer them after the following two slides. As a last topic, Hon Chuan, could you give your views on the impact on APAs, please, from a Malaysian point of view?
Yeah. APA is rather still a stranger in Malaysia, both bilateral and unilateral. Though IRB has also issued an FAQ on APA to provide clarifications on APA to taxpayers, right? It's very similar to the one covered earlier by Kevin, but the main difference is that now new APA is only applicable to businesses that are not significantly impacted by COVID-19, right? So it's only the fair few businesses that are not significantly impacted. So basically, APA, it will be more on ongoing APAs that the taxpayers has gone through. So if you have any concerns on APA in Malaysia, you can actually contact us.
Thank you, Hon Chuan. So I think with that, we are gonna open for questions to the floor. Before we get into the questions, I would just like to summarize like a few key points from our discussion today. Point number one on our top tips is to gather robust documentation. And I will say gather robust documentation means value, value, value. If there is anything you're going to get out of this session today, value, 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 value the impact of COVID-19 to be able to have a robust position. Second, reassess comparables and search criteria. And in Malaysia, probably as we have majority being local comparables, they're also focused on industries to be able to gauge very clearly the COVID-19 impact. As a third point will be to analyze the specific COVID-19 cost and whether there is a basis to treat it as operational versus exceptional, or whether you have to keep or not adjust these costs. As a fourth one will be to analyze very clearly the treatment of the government assistance, because as we saw, there is not only government assistance in Malaysia, but also tax incentives. And most likely, it would be very hard to substantiate the possibility to pass the government assistance benefit to related parties. As a fifth one will be to notify the tax authorities on any breach of critical assumptions in APAs. And obviously, refer to country-specific transfer pricing guidance. I think in the last seminar that the IRB, one representative of the IRB he mentioned that it was not in the agenda to do a robust country-specific transfer pricing guidance, but rather an FAQ like the ones that they have been releasing. So anyway, stay tuned. Given that now we are in second year of COVID-19, they may change their mind. And with that, I want to open the floor for questions and see if feel free to ask any questions using our Q&A chat box. Okay, so there is one here, and I'm going to put to answer live. We understand that if our threshold in Malaysia is less than 15 million, we only need to do limited documentation. Can you go through with us the required benchmarking analysis in limit TP documentation?
Yep. Yes. I think we discussed earlier in the previous webinar, right? A full TP documentation versus a limited TP documentation. the difference is just the amount of data that is required in a full versus a limited TP documentation, right? But the same thing would be the economic analysis, which means that benchmarking analysis, right? What you've done in full TP versus what we are going to do in limited TP, it will be virtually the same, right? The process will be the same to form the same comparability analysis, to go through the similar functions, your geographical arrangements, your contractual terms. So basically, it will be the same as though you're preparing a full TP documentation. Not sure whether that makes sense.
Yeah, that makes sense, because I think maybe the question is whether the benchmarking is different, and I think it's not. It's probably the other analysis that can be a bit different. I do have a question which I would like to get a little bit of views from you both, and is on the multi-year analysis aspect. Do you think that IRB will be willing to accept the multiple year analysis?
Well, maybe I can answer that first. So
yeah,
theoretically speaking, year on year is definitely the best approach and the most reliable. But practically speaking, actually multiple year data, we're actually not a stranger to multiple year data, right? Even pre-COVID, right, multiple year or weighted average year has been used throughout the process, right? So there are circumstances where you can use multiple year data and has been accepted by the IRB. So it depends on various abnormal factors, such as the availability of the latest year financials that we are currently facing now, or where you are in certain industries, right? It's very industry specific. I'll give an example, such as the property development or construction industry, which is very rampant in Malaysia, where the overall company business operations does not start on day one, right? So the property development industry, it goes through different phases of development. So you have your startup phase, you have your building stage, you have your finalization stage, right? Each comparable independent construction companies would have been in different stages, right? You wouldn't have all the companies will have in the startup phase, right? Some would be in the middle development, some would have mature development where they have already constructed a few developments. So in that sense, a 5-year approach, 5-year weighted average approach would make sense to actually account for the fluctuation in revenue undercovered by these companies. So when you have to take the weighted average, that would make more sense, right? If you
yeah. Thank you. Thank you. I think that comes even back to our OECD Bible, which the OECD Bible actually says that TP Basics is coming to this industries that have long cycles. And if that's the case, then there is a reasoning behind using multiple years. And my last question will be, what is the opinion? We talk about the limited risk enterprises, and if you had to choose between two options, what would you do? Would you consider a loss position or a reduced profit? What will be the most risky or the less risky approach when it comes to limited risk entities?
I'll let Kevin take that one.
All right, your question was if just to get it right, whether or not if I'm a limited risk entity, do I prefer reduce profit, reduce revenue, or going to losses?
Yeah, reduce profit or going to losses. And let's assume that maybe, and would it help group losses in this situation?
Yeah, I mean, like this again go back to whether or not you should be bearing certain costs and risk, and obviously if you have some sort of responsible in the risk and functions related to, like, for example, market risk, and your whole group is in losses, naturally you would bear some of these losses as well, to be proportionate with your risk profile. But there's no clear answer of whether I would prefer to have a lower profitability or losses. Obviously, a bit of profit is better than loss position, but whichever way you go, it should be supported by, is it proportionate to my risk profile? It's obviously, for example, if in the arrangement I'm not exposed to market risk, I'm not exposed to any significant market risk, then I should not be in losses as a result of the market downturn, right? Yeah. So I think that's the approach. We need to sort of make sure that everything we do in terms of whether or not we are having losses to be proportionate with our risk profile for the entity.
I like that. I like the word risk, and whether I'm bearing the risk and I'm controlling the risk as an entity, then maybe that allows some room for bearing some level of losses.
One last question.
Yes.
You want to go through?
Give me 2 seconds. Do we have one last question?
Yeah.
Okay. So answer live. Is it reasonable to put a 5% markup for limited risk services call center in Malaysia? So we are getting asked to have the crystal ball. Who would like to answer?
I think as Kami mentioned earlier, well, first you have already assumed that you're a limited risk. So first we need to make sure that that characterization is correct in the first place. And to look at what service is actually provided. So it depends on the service rendered, it depends on the benefits received, right? And though we can't answer that 5% markup, because in Malaysia, there's no, we call it a safe harbor rule, where the tax authority actually provide you a certain percentage of markup for routine or limited risk, as you said earlier. So for this type of services, but there are other countries that has provided, such as Singapore and Australia, where you can actually apply that safe harbor markup. So I couldn't answer that 5% until we know what service is actually provided by the Malaysian taxpayer.
And I think that's the challenge with the Malaysian TP, which if you don't even have any guidance on what's the floor, that it becomes really difficult to say, yeah, this is okay or it's not okay. But I think your point on the type of service and the characterization is the key to then answer the market aspect. A lot of taxpayers are very focused on the markup part of a service charge, but there is a lot more to it. For example, the type of service, the characterization, and even the cost base. So
yep. Cost base.
Let me just double check if there are no other questions.
I think that's about it.
Okay. If there are no other questions, that concludes our webinar for today. We will be more than happy to have you all participated in our upcoming webinars. We have a very exciting webinar season coming as of June, with 1 webinar per month. So please be mindful and check and be open or free to register. As you know, we provide transfer pricing advisory service, and we can help with transfer pricing documentation, master files, local files, regional documentation, transfer pricing contracts, global, regional, and local benchmarkings. If you want to also subscribe to our YouTube channel, yes, we are in YouTube. And we love what we do, and we have now become also YouTubers. So feel free to join our YouTube channel, and we hope you enjoy some of this regular content that we're always publishing in our channel. And if you have any questions, feel free to contact us via our website or in our email, services@transferpricingsolutions.my. Follow us in our channels, because we are not only in YouTube, we're also in LinkedIn, Facebook, Twitter, and soon Instagram. Okay, with that, thank you very much, everyone.
Thank you, everyone.
joining
Thanks,
us
guys.
today.
Thank you.
Thank you.